Hi, after understanding the key terminologies behind financial accounting, let's get into the details of financial statements. There are different statements, but these statements are basically the written records that talks about the business activities any organization is performing and also about the financial performance. Now, these statements could be of different types, and these statements are basically relying on the financial data which sometimes the investors or financial analysts they analyze for ensuring that company is doing good or not. And it is also helpful to make some informed decision or predict the future direction of this particular organization. The three key important financial statements which normally any analyst or investor look into are the balance sheet, the income statement, which we call as a profit and loss statement, and then the cash flow statement. Now, these all statements we will understand with respect to telecom industry with one of the example we have made a separate different these statements for one of just random organization of telecom industry, and we have compiled all the information. We'll go through it for all the three statements, and we will then give it to you for doing some hands-on exercises on those Excel sheets. So first thing first, the balance sheet is basically about the financial position of an organization, and this is measured at a particular instance at a particular time. Now, this balance sheet considers three important factors which we talked about. Three important terms are the assets, which we talked about, which includes both the current and non-current assets. Second is the liability, again the current and non-current liabilities, and third is the equity. So the balance sheet covers these three important terms. We'll get into more details of that. After that is the income statement, which we also call as profit and loss statement. Now, this statement actually talks about the revenue, what a company is generating, how much cost they have to put in to generate that revenue, and then see that is the operations of this business, of this organization is profitable or not. Then the third statement is more around the cash flow, how much cash an organization is having. Now, this cash is what we have seen in the previous statements. It's a little bit different from that. Now, if you remember, there are two different methods of reporting or recording the transactions. One was the accrual method, another was the cash-based method. If you remember, most of the organizations, the bigger organizations, they are focusing on accrual method, where irrespective of when they are getting the cash, when actual transaction happens, they are not considering that. They are considering when somebody, an organization is buying or selling the products or services, they will record on this in the same month. Whereas if the cash is coming later on, it means probably it may come after a year, after this financial statement is made. In that case, we need to adjust all those different gaps in terms of account payables or account receivables to ensure that what is the actual cash flow the company is holding. And that's where the difference is in terms of when we are comparing it with the balance sheet and the income statements. We'll look into these statements in more details. Let's start with the balance sheet first.